Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Are investors too complacent in front of a key earnings week? Joining me to discuss, we have Steve Sosnick, chief strategist over at Interactive Brokers. Steve, it's great to see you as always. Welcome back to Trade Talks. And that really is the question everyone's asking with this choppy trade, the VIX kind of at the levels where it is sub 17. What are your thoughts here?
Good. Always great to see you, Jill. Thanks for having me. I kind of do think we're seeing a bit of complacency here. Now, to some extent, it's reflective of what we see in the markets, which is very little movement in the broad indices. Remember, most of your big volatility indexes are measuring broad index moves, but the problem is we can't really tie into what, we have to tie that back to what we're seeing in the real world, and that is a certain amount of complacency. And one of the charts, the chart that you have up on the screen is basically how traders are viewing Microsoft ahead of earnings, which are tomorrow evening. And what struck me today was that the most active line in Microsoft was the 300 calls expiring on Friday, at least when I looked at it earlier when this chart was made. And typically what you see for in major stocks ahead of earnings is greater preponderance of hedging activity rather than speculative activity. You don't normally see people clamoring for the upside calls. We saw the vols come, the overall levels of volatility come way down sequentially from September to January till now. That fits with what we saw in the market, because in October, we were sort of flirting with lows. January, we were coming out of a lousy quarter. This quarter, everybody seems copacetic. But also the skew is flattened out dramatically because people, they're not as concerned about downside. One of the things you and I have talked about is that these very, very big stocks can have sort of a gravitational pull on the index to a certain extent. At Microsoft's about 12% of NDX, for example. It's math here. I'm not rooting for or against Microsoft by one way or the other. I'm certainly not rooting against it, but I think people have to be a little cognizant that if there's a bit of a misstep by Microsoft, it will spill over into other stocks. It has to.
Right. And, when you think about it, the majority of the mega cap stocks that have been driving performance in the market this week, many of them are reporting. And are you worried that participation is not broad-based? And because it really has been concentrated in those 9, 10-ish so names.
Sorry, I forgot to mute my phone.
Oh, happens all the time.
Sorry, I always remember. I am very concerned because I think that, narrowing participation, you and I have spoke about this before as well, narrowing participation, narrow leadership is not a good thing. If you think about, I don't want to make too weird of an analogy, but think about a building, that has a broad foundation versus one that has a very narrow foundation, which seems more stable. And the problem here is if you've had a few stocks lead us up, if they stumble, they bring us back down. Whereas if you had this broad-based leadership, you might not be as concerned that one or two stocks would spoil the party. And the other thing to keep in mind, by the way, we do, you mentioned the mega caps this week. Apple, for whatever reason, is taking sort of a week off, so to speak. They're next week, but that's also the day after an FOMC meeting. So it's not like there's any shortage of volatility-inducing events coming down the pipe. But right now, we just sort of seem to be looking through them.
And that was another question I wanted to ask you. I mean, the market does feel a little bit quiet. You and I were talking earlier this morning. There's really not that much to talk about today, relatively speaking. Do you think part of that function is there was no Fed meeting in April? Because it's still, even though we're in the middle of earnings season, everything's going to heat up this week with the mega caps reporting. It feels as if everything is still trading on the macro, not necessarily fundamental. So do you think that's part of the function that there just was no Fed meeting this month?
I think so. I also think, remember, there was also a big sigh of relief in April as opposed to March. At March, you mentioned the Fed meeting, but we also had a banking crisis. Fortunately, it didn't metastasize into anything more than a relatively minor one. And I'll argue that we're still not fully through it for, it's got dislocations going on in the money markets. And I wrote about that. I'd be more than happy if you guys looked it up, but I think it's not necessarily as germane to this. But the bottom line is We got through a lot in March, and I think people are glad to see that April has been relatively uneventful, and that we have recovered much of it. But recovering from a scare does not necessarily give you grounds to be complacent about what is to come, and that is earnings, a Fed meeting. And by the way, the debt ceiling is not apparently getting solved anytime soon. And so, this one, we've dodged those bullets before. We've had a lot of, go up brinksmanship, shall we say. This time, it just seems to have a different feel to it. And again, I've written about this. The money markets are weird, and definitely anticipating a little nervousness that this might actually turn into something larger. But stocks don't seem to care for now.
So tell us more about that then, money markets. What do you see there that makes you think there could be something potentially down the road?
Well, what happens is there's two aspects of it. The 1 month bills are trading about a full percentage point or more below the Fed funds rate. They really should track the Fed funds rate almost perfectly. What it tells me is that a lot of the money that came out of bank deposits, went into money markets. The money markets have to put it someplace. They put it in short-term treasuries and the like, and that depresses their yield, raises their price on a relative basis. So that's part one. But they tend to have an average maturity of something greater than a month a lot of times. But the bills that mature in 3 to 4 months are above where the Fed funds rate is implying. And that's telling me there's a little bit of risk aversion going on there. I don't think they're worried that they're not going to get paid eventually. But what would be likely to happen is if there's a government shutdown and they can't pay, you'd basically have this IOU. The government will pay you the money when it's time to reopen. There'll be a secondary market in those bills that are sort of in limbo, but they won't be 100 cents on the dollar. And that's actually what's being reflected in 3 to 4 month bills. So the fixed income markets are telling you that the banking crisis money hasn't fully flowed back to the banks, while at the same time it's kind of avoiding these the maturities that would be most likely affected. But again, stocks are in their own world. Who knows? Maybe we've actually found the mythical stock equilibrium, and these are actually the prices where they should be for time immemorial. I highly doubt it, but maybe that's the answer.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.